Hi, welcome to another edition of Nucleus Investment Insights. Apologies for anyone who is logging on early. We had a little bit of a technical problem at the start, but hopefully it's all back up and running now. So the main thing I wanted to run through this week is a valuation roundup. So looking around the markets, how expensive are markets? Where are they? What's really happening in terms of growth? Because there actually is some quite interesting factors in the growth side at the moment, and I think it's well worth considering what's going to happen in terms of your different scenarios. Are we at the start of some sort of big tech boom at the moment, or if we're not? But what earnings are doing is interesting in either way. So just a quick reminder as well: nothing you hear today is personal advice. Everything's general in nature. If you do want personal advice, give us a call. Book in a call on our website, and we should be able to help you out. And with that aside, I'll jump straight into valuations. And the one thing I do want to start with, though, is the earnings side, because the earnings is the most important part of this. And I think in terms of the earnings, if what we're looking at is when you consider markets and whether things are fairly valued or not, the biggest thing you have to consider is this idea that we've got we have this earnings over time that keeps rising. And that's sort of your main, whenever you're concerned about markets, your main issue is working out what is happening in terms of those earnings, and are they going to be going up or down over time. So I've got a chart up on screen just sort of showing how over a very long period of time, you just sort of get this 45-degree line, keeps going up, and it has these various falls. I've got two lines on there. One is the red line, which is the forecast earnings, and then the other one is the blue line, which is the last 4 quarters. And I've just used the S&P 500. It's pretty similar when you look at it on a global basis. And the key, there's a couple of interesting things when you look at this chart on a longer term basis. Now, theoretically, that red line is the analyst forecasts. That should be telling you where the blue line is going to go. It's not particularly good at doing that. So at turning points, quite often you see that the actual earnings and the forecast earnings both turn at the same time. And so what does that mean? Well, it means that analysts in over the future are not particularly good at forecasting when the turning points are. But there are times when it diverges, and at times it diverges is trying to work out, well, who's right and who's wrong. Now, I've had some divergence over the last sort of year and a half, where our argument was that the analysts were wrong and that the earnings are going to be much weaker than expected, and that sort of came pretty much to pass. But we're actually starting to have this big divergence at the moment, and I'm going to dig in a bit deeper into that, and that's sort of the key reason for talking about this now. And the questions about where's that coming from, because the divergence is actually a lot more than we would have expected, and signs that quite possibly we're reaching a point where earnings may well have bottomed, and working that out is sort of the key thing for us at the moment. Another chart which you can look at, which is sort of the same chart in a way. This one, we've got this black line, sort of the same, following the same path, rising from over time, and it's the forward earnings. And the idea with this forward earnings is, as long as that's going up, then you don't really have to worry too much about it. But I guess the key thing I want to note with this is that I've got some lines in there, some colored lines, which are showing what the individual forecasts are doing for each year. So if I jump back in time to sort of the 2012, 2013 type numbers, what you can see is that that's showing you, say, for the line that's marked 13, is that over time, you had these 2013 forecasts come in, and then they just got downgraded by probably about maybe even more than 10% over time. But the black line kept rising because the next year kept on, even though you've got these, each year is being downgraded, but you've got this future outlook that keeps getting better and better. And so the fact that downgrades on their own are not necessarily poor for the overall market. And I guess what I mean by that is if everyone's expecting there to be 15% growth, but there only comes in with 10% growth, well, 10% growth is still pretty good. And that's still going to, you get if you've got earnings going up by 10% and you're getting a dividend yield of 3 or 4% as well, that's a 13 or 14% return. That's not a bad outcome. And so it's a mixture of trying to work out how optimistic are forecasts, because forecasts are probably going to fall, and then will they fall far enough that it actually drags down the actual number. And that has been what's been happening in the last few years. What we've seen is that the earnings forecasts have been so optimistic, and the downgrades have been so far that what's happened is the actual earnings have been falling. So that's where we are, sort of in a longer term sense. Now, if we look at that, sort of zoom right in on that, and just look at these last couple of years. So I've got those same lines. Now what we've got is we can see 2023 numbers sort of started at if we use like and the numbers aren't sort of necessarily that important in terms of this, but started at 250-ish and then ended up at 220. So you sort of over a 10% downgrade in terms of the numbers to basically a flat return. And then 2023, so you got most of the downgrades in throughout 2022, and then basically flat from there on. Now that's been the same for 2024. We've seen some pretty big downgrades, but the most recent downgrades really were in the first quarter, and the actual earnings and the numbers have actually been holding up all right for the second quarter and beyond. So we can see that red line is still rising, and now a lot of that is because of the optimism that's sort of baked into 2025 numbers. That's sort of looking like 2025, sort of looking at 13 or 14% growth now in terms of that. So basically a boom year forecast. But it might be wrong. So say we don't get 15% growth, but maybe we get 7 or 8% growth. Well, that's still a pretty good return overall. So the question is, how far will those numbers fall? If you look at through some of the quarterly numbers, you sort of see some similar ones where earnings are sort of, we haven't seen a lot of downgrades. We saw a lot of the downgrades to Q1, but we haven't really seen as many downgrades to Q3. And if I look at that a different way, I've broken this line. I've broken the chart up now, and just looking at the global earnings now. So the top 1,000 stocks I've pulled out. On the left-hand side, we've got what the numbers were 3 months ago, and I've broken each of the bars up into different elements of the market. Now, one of the key parts I've broken out is what I'm calling sort of the big 8, and basically what it is the top 6 tech stocks, which have really been booming in terms of earnings, and then the weight loss drugs as well, which have seen some pretty decent upgrades in terms of earnings. And so I've broken those out as the first part. Then I've looked at the rest of the US, excluding those, and then diving through other areas of the market. And so what we could see, 3 months ago was that there was a lot of growth forecast for that sort of big 8, plus the rest of the US, and then the rest of the world was basically not doing nothing or going backwards a little bit. And that is basically the same case as, so we've rolled on 3 months, and we've actually seen some upgrades, and not only upgrades to that sort of big 8 stocks, upgrades as well to other stocks within that US. And that's, I guess, where this question mark over, look, have earnings actually bottomed? Looks like it might be worth considering that, and we're about to hit this reporting season. So the reporting season starting in probably 3 weeks. There'll be a few companies in about 2 weeks starting to report, but really over the next a month to 6 weeks, we're going to really see whether earnings are holding up a lot better, and why that's probably not as stark as what I've shown on that graph. But I just want to, I've got another one which is showing what happened in the first quarter, and then what's forecast to happen at the moment in the second quarter. So we can see in the first quarter earnings per share for the top 1,000 stocks globally was down about 4%. So we had a 4% fall in earnings. The second quarter numbers are currently forecast to be up 7%. So that's a massive turnaround in terms of earnings. And what's been happening with that is, that first line on that's that sort of big 8 stocks. So where's that growth coming from? So basically, in the first quarter, all the growth came from those big 8 stocks. So you got 4.4% growth from them. So basically, if it wasn't for those top 8 stocks, the earnings would have been down almost 10%. But what we're seeing coming through at the moment is that there's actually still pretty solid forecasts for the rest of the market, and that's the real key to whether we can see some, I guess, a lot more strength than what we've been expecting, and whether maybe some of these numbers in terms of the earnings numbers we've been talking about, really might be hitting a bottom, and maybe there's some upside still to come from earnings. So I've got one more chart I just wanted to jump into was that's probably that's probably something I might just jump to a quick sales message, and then we'll be back with more about some of the sectors.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Okay, so then the next real key is, what does that mean for valuation ratios? So I'm going to pick on some price to earnings ratios here, just because they're the most commonly seen out there. I'm going to come back a little bit later to that. In terms of individual stocks, you really want to be jumping in on price to cash flow ratios as one of your key measures. But let's just talk about this just because it's a broadly used metric. So overall, we're talking about forward earnings of about 18.5 at the moment. And I've got a chart up there sort of showing where that's been over time. So back in the tech boom, 25 years ago, that sort of reached peaks of sort of 25 times. So, you could add another third, I guess, to from where we are now. Just in the most recent past, as we came out of COVID, that sort of hit these levels of sort of 20 times. Now, keeping in mind that the COVID ones is on a more depressed earnings. So the idea was that, look, earnings are quite low, but they're booming as we come out of COVID. And so therefore, you can afford to pay up for, say, next year's earnings, because earnings 2 years out was not as expensive. And so, when you do these charts on a sort of 2-year forward basis, it does look a little bit better. So that's sort of the overall global numbers. I prefer to look at it again on a slightly different basis. I prefer to try and look at it excluding financials and resources. So 2 reasons for that. One is the financial side can be, it's a very leveraged sector. And so you have lower PEs within that sector. And what you can find is that you actually get a distorted view about what's going on as a global, in terms of that global financing side. So, we're really looking at companies outside that financial sector is more important. And then secondly, resources. Now, the reason for resources, so both energy and material sectors, is that those sectors, that the price to earnings ratios don't always reflect the value. So, and what I mean by that is, when you have oil prices of $150 or $100 to $150, earnings were really high for these companies, and the valuations tend to be really low. So people are effectively looking at it going, yes, the oil price might be $150, but that's not sustainable. So I'm not going to pay you 20 times earnings for oil prices of $150. I'll only pay you like 8 times earnings. And the flip side is, when oil prices are really low and these companies might not be earning anything or earning very low numbers, people are actually prepared to pay really high multiples on it, because they're putting these average prices in. They're saying, well, the real price isn't $150. The real price isn't $30. It might be $50 or $60. I'm going to put into my longer term model, and that's the price I'll base it off. So you can get some quite big distortions. And if you do that, then we're at 21 times. We peaked out in that coming out of COVID at 22 and a bit. So we're pretty close to the peaks there. And then if you look back to sort of the last tech boom, you're more like 30 times for that. So where are we right now? Yeah, it looks quite expensive, unless you think we're going into some other, either a big earnings growth, or we're looking at another tech type boom, and both of those are potential. If you look at Australia, how Australia sits with that, now these charts are I've got a few ones up here, just sort of showing Australia versus the world, which I don't think is that important. So Australia looks cheap versus the rest of the world, but I actually think that Australia versus the world is not really worth looking at, because the Australian market is so exposed to both banks and resources. So banks and resources, you end up with sort of 50% plus of the Australian market, whereas in other markets it's more like 15%. And so if you strip it out and sort of say, well, let's look at Australia excluding banks and resources. If you look at Australia, just the banks, Australian banks versus world banks, and then Australian resources versus world resources. Now, I'll jump to the more interesting one, which is Aussie banks versus world banks, and for a large part, this is CBA. We're talking about a 60% more expensive than world banks, and it's sort of at pretty much record levels. Traditionally Aussie banks are more like 20% more expensive than world banks. So right now we're talking about quite extreme levels, but they've been extreme for a number of years now in terms of where they sit. If you look at Aussie resources versus world resources, it's about average. Nothing really to write home about there. And Aussie stocks, so whereas if I went back 6 months or a year, they were looking a bit expensive, the ex banks and versus world. Now it's actually starting to come into a little bit of value there. And then the question is, will you get exposure to both that? If we're getting earnings growth or we're going into a tech boom, are you going to get exposure in Australia? And there are some question marks on both of those questions for Australia. So yes, it looks cheap, potentially deservedly so, but I guess it's yet to come. I guess being careful about what stocks we're gonna choose within those. If we jump to Europe, we can see Europe versus the world is actually off the charts in terms of being cheap. So Europe does look very cheap. There's growth issues within Europe, so that's certainly the major factor. But Europe is very cheap versus the rest of the world relative to where it's sort of traded over the last few years. And the other one, Japan, we've actually had some reasonable growth in Japan and some decent earnings growth. Despite that decent earnings growth, Japan still looks cheap. So much cheaper than the rest of the world. And we still think there are some opportunities within Japan for in terms of valuation side. So as you run through that, every sector is cheap. Japanese resources, don't worry about. It's actually there's not much there. But Japanese banks and Japanese ex-banks are both look cheaper than the rest of the world. Then the other one I just wanted to highlight, a couple of the sector ones. If we looked at the IT sector, it does look actually relatively expensive on this basis. And keeping in mind the IT sector doesn't include a lot of the bigger companies you might think. So things like Amazon aren't in there, Google, Meta. Those companies fall into different sectors. So, but if we look at this as information technology sector, and so this is largely the moment NVIDIA and a bit of Broadcom, and then a bunch of other smaller companies fit into that. So if you look at those ones, we're miles off those peaks you saw during the IT boom, particularly on actual earnings. I guess the flip side is those actual earnings, in the IT boom were close to zero for a lot of stocks. There's a lot of, trust me, all the earnings are coming through next year. So if you looked at forward earnings, you reached peaks of 25 times for that IT sector, and we're not that far off. If you added 20% of the market or 30% of the market, you'd be back to those levels. But it's still relatively expensive. But I guess some scope for that to increase. And if you looked at it as what were the peaks, coming out of COVID, you're probably another 10-15% away in terms of those valuations if you wanted to get back to those sort of peaks that we saw coming out of COVID. I guess that's that overall message for a lot of this is, look, it's expensive, the market, similar to this IT sector is similar to the overall market. It's expensive. If we're going into an IT boom, some sort of AI boom, then it can get more expensive. If we're going into an earnings boom, it could probably get a little bit more expensive. But if you're talking about just where does it sit versus the whole of history, it's certainly more on the expensive side than the cheap side. And the other one is the communications sector. Now, this is a little bit weird insofar as the communications sector 20 odd years ago was more about some of the telecommunication stocks. Having said that, they were sort of thought of as being the heart of the internet, and a lot of those telcos that were sort of putting on, whether it be things like AT&T and companies like that, ended up being utilities, but were thought of as growth stocks at the time. And potentially that's where you're looking at the sectors now, where you've got companies like Google and Facebook within that sort of sector at the moment. So again, expensive relative to history a little bit, not greatly, but certainly well off the peaks that they reached in some of those prior booms. And actually, before I jump into this one, though, I might just have another quick sales message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Before I get into some of the other factors, I just wanted to highlight another measure that the Fed has this sort of stock valuation model that looks at basically earnings yield versus the 10-year bond yield. And I just thought I'd highlight this one. It's potentially, this model's, certainly for the last 10, 15 years, this model's been thought of as dead. But it is sort of worth, I guess, an overall thought on this one is what it's looking at is saying if you look at the yield you can get on stocks versus the 10-year bond yield, if the yield on stocks is higher, then the stock market's expensive. If the yield on stocks is lower, then the stock market's cheap. Now, there's two elements to this. So one element is, are bonds expensive or cheap, and then are stocks expensive or cheap? Because I guess this model assumes that bonds will always be the right price. And so if we look through this from sort of 1985 to 2000, there's a pretty decent relationship between the two, where one would be a bit expensive, the other one would be a bit cheaper or whatever. And then we have this sort of 20-year period with this huge divergence where the forward earnings yield on stocks was much more than the yield on bonds. And so from basically from the 2007 the financial crisis from then on. If you look at this chart in a different way and look at sort of whether it's overvalued or undervalued. So basically what I'm doing is turning those two lines into, which is higher, which is lower. And so you can see those period, during to and up to the financial crisis, where the S&P 500 looked like it was overvalued, and obviously also during the tech boom. And then we had this sort of 20-year period where it looked like it's been undervalued, and we're sort of closing back in on that fair value, or where the S&P might be overvalued. So I guess that's one thing to keep in mind. It does depend largely on your view about bonds. So if your view is, look, bonds are back to where they are, and that's the level they're going to stay, then you're starting to look and go, well, maybe the stock market might be more overvalued or getting closer to overvalued. But if you've got the view that, look, maybe the bonds have actually run too hard, and we're about to get some real productivity gains coming out of AI, we're about to see China just continue to export as much deflation as it possibly can, then there's an argument that then bond yield will fall, but then that'll lead to stock markets rising even further. So that's the sort of that overall value. I also wanted to talk about sort of where value sits in terms of factor returns. And so for anyone who hasn't sort of listened to these ones before, what I'm talking about here is splitting the markets up into, where did the returns come from? And so at different times, you look at different measures as sort of driving the value. And I've got the top section is what's happened in the US over the last sort of decade or so, and the bottom section is Europe. And so each of these lines is each of these rows is a quantitative factor you can sort of try and invest in. So analyst expectations is basically saying, look, if I buy the stocks which have got analyst upgrading earnings the most, and it's green, then that's been a successful strategy. And what I'm looking at here is if you took the top quartile, so the top 20% of stocks versus and bought those, and then went short the bottom 20% of stocks. So if you did that this year, basically you've got 25% return. So basically I'm buying the stocks where earnings are going up, and I'm selling the stocks where earnings are going down. And so what does that mean effectively for this year is, well, you're probably buying AI stocks and selling some of the old industrial stocks and maybe some of the resources as well, where you're looking at or energy stocks where you're looking at weak earnings. And so, so that's sort of generated this great return. You can see down the bottom there, sort of second from the bottom is valuation. Now, valuation has been, for the last decade or so, a pretty bad way of getting returns. And when I say valuation, I do want to preface this. I'll jump into it a little bit more detail in a minute. But what I'd call this is naive valuation, because I'm going to go into what factors fall into this. But buying stocks because you think buying the cheapest stocks basically has been a real loser of a strategy this year and last year. You had a fantastic year in 2022 when everything else went the other way. But besides that, the last decade or so, there's been a lot more poor years from that than good years. If you jump to Europe, it's a similar story. You said sort of similar thing in 2022. Where you got these great returns from it, but it hasn't been as bad this year, but it certainly hasn't been over that sort of decade or so. It certainly hasn't been a winning strategy in terms of what you're doing. So so I guess buying stocks just because they're cheap, I guess it hasn't been a good strategy, and not necessarily as well, and certainly for this year. So this is a strategy which is more about saying. When times go into trouble or the end of cycles, when you're seeing inflation, often there's a lot of cheap stocks that can rally at that point. Now, I've dug into each of these factors here, looking at it in more detail, and said, well, where has that return come from? So I've got up on the screen again the US and Europe. And what we're looking at there is what are the valuation factors. So one of them is the FCF to price is saying free cash flow. So if we use free cash flow as your valuation metric, all of a sudden things look a lot better. So not only you didn't do as well in 2022 when you were using that, but actually year to date, rather than being minus a huge negative, you're actually pretty close to flat on that in the US. And you're positive within Europe. Europe, actually, the price to earnings has been better, and there's some questions in terms of whether GAAP accounting and IFRS accounting, and there's a few sort of inside baseball sort of things on how you're looking at numbers, which we think sort of if you flip around the way you use numbers, price to earnings can look a lot better, and that's why you see it looking better in Europe. But I guess the overall message from this is that cash is king in terms of, it really is about looking at those right metrics. And that if you look at a lot of these other sort of, I guess what we call naive value in terms of looking at historical values of price to earnings, or looking at, measures of dividends or the book value, you can actually quite often end up in a lot of trouble and having some quite negative returns on that basis. And so, I guess the message coming out of that is that what we're really saying to people is look at the look at those valuation metrics which are right for the particular stock or sector. Don't sort of focus too much on that. The idea of what the headline numbers are showing up, because a lot of these numbers really don't have the track history in terms of what you're looking at. So I think that the key things I guess I want to focus in on from an investment point of view right now is the real question is, are we going into some sort of tech boom or not? So is there an AI boom coming or not? And so that sort of gives you've got sort of that question comes first, and then the next question is about earnings. So if we're heading into some sort of if we're in the early stages of tech boom, then there's more valuation upside to where we are at the moment, and there's probably more earnings upside in terms of where we are at the moment. But earnings are less of an issue. It's about saying it's the valuation side that's sort of going to drive this in terms of tech boom. If the views we're not going into a tech boom, which is sort of your downside risk, so you've got sort of this upside, do we go into the tech boom? The downside part of it is then it's a real focus back in terms of earnings. And the question and so last quarter you were sort of saying, and for the year or so running before that is, well, if we're not going into a tech boom, earnings are really weak, and every quarter things would roll around and analysts would be going, oh, we're going to get 7, 9, 10% growth this quarter, and then that would turn into a negative number by the time you actually got it. And analysts would just then roll that out and go, oh, well, we didn't get 10% growth this year, this quarter, but it's going to come next quarter or the quarter after that. And what we saw was that earnings just kept on getting downgraded, but analysts would just keep upgrading their later year forecasts. That might have reached the finish. We're almost at the start of the reporting season. Analyst forecasts are pretty strong for they're talking about a close to a 10% turnaround from a negative 5% growth to a positive 5% growth, ballpark for a lot of companies. And so even if you've got this view that look, there's not going to be this AI boom, that we really need to focus on fundamentals. The fundamentals might be improving quite significantly, and so that's the sort of key thing to keep an eye on over the next month or so as we see those earnings come down, because what that means is that sort of puts a bit of a floor under how far you think the market could fall. Because if you're worried about earnings and you don't think there's a boom coming, then you sort of go, okay, earnings fall, valuation could fall 10, 15%, earnings could fall 10, 15%. And now you're sort of talking about markets that could be down 30%. But if you're not, and you're saying, well, valuations could come off 10 or 15%, but actually maybe earnings are understated and earnings might rise by another 10 or 15%, then you're saying, well, maybe there's only 5% downside to the market or 10% downside to the market. If sort of valuations, if the price doesn't go anywhere, earnings goes up by 10 or 15%, and that just improves what value you're getting for the market. So net effect is, I think the floor looks like it might be rising, and then there's always this upside potential from an AI boom. And so so our view is that look, concerned about where things are in markets and all that sort of stuff like that, but it's a question about holding. Not holding a reasonable amount of equities at this point, given the potential outcomes that we can see. That's all I have for today. Thanks for tuning in. You can get us on a whole bunch of different channels. We have our social media where you can capture us on Twitter, Facebook, LinkedIn, Instagram. I think there's a TikTok up at the moment. I don't do a lot of that myself, but that's up there. And then in terms of all the podcasts, Apple Podcasts and Spotify, you can also get us. I think Google Podcasts is shutting down now if it hasn't already, and so now it's YouTube podcasts. But you can also all the major and minor podcasts you should be able to get us from. You can jump onto the Nucleus Wealth site. If you've got any comments or topics for suggestions, leave them in the comments of the YouTube. And if you've got, if you want to see more of what we've got, nucleuswealth.com/content, where you can sign up for our weekly newsletter, and we'll send out all this plus more. Thanks everyone for tuning in, and we will see everyone next week.